And so I want to talk about the July housing statistics, which were just released, which say that 32% of mortgage and rental payments in aggregate were not paid for the month of July, or they were only partially paid, which means that 1/3 of households, or 1/3 of people living in the U.S. paying off their mortgages or renting, are now behind on their payments. Most of them at least 1 month, many of them multiple months, because the statistics for May and June spiked as well. And so now they're multiple months in debt, which would usually mean that they would be evicted. But there is, fortunately, a ban on evictions, or at least a partial ban on evictions federally, which goes through August. And there's also certain local and statewide bans on evictions, which have been keeping the number of people thrown out on the streets lower than it otherwise would be. But that's a short-term solution, because the coronavirus is going to be with us for at least a few more months, and probably till the end of the year, and it could be well into 2021 or later until a vaccine is developed, and even then it might not be a full vaccine. And even if it was developed tomorrow, a lot of the companies which have laid off workers have announced they're not planning on rehiring all those workers when we get back to business as usual. And so in that way, the virus has just sped up the process of outsourcing and automation, which was happening previously. But it's not going to be a return right back to where we were at the start of the problem. But that's just the short-term problems in terms of the economy. The longer-term problems are structural and have been ongoing for decades, not just months since the virus began. And those problems are U.S. wealth for the median American, or for middle class people, has been shrinking and shrinking since the 1980s, or since the late 70s, and incomes have been stagnating or decreasing for most workers since the 1980s, despite efficiency increasing over time as technologies make the world wealthier, but all of the wealth goes into just a few hands. And over half the country lives paycheck to paycheck, and I forget what the statistics are, but a very large number of Americans, I think it's around 60%, said that they do not have enough money for a $500 emergency, and that was before the crisis. And that's manifesting itself now when their rent payments and their mortgage payments, which are on the order of $500 plus or minus, come in, and they don't have the incomes anymore to supplement them. And so the $1,200 was helpful, but that only gets you so many mortgage payments, maybe one or two, and now it's July again, and you still don't have an income, and so you're unable to pay your mortgage payments. And if we had, if people had a little bit of a safety net in terms of the middle class had built up their wealth over the past 40 years, so that they had 4 or 5 figures in the bank, rather than just 2 or 3, then they would be able to quell this situation for the coming months without the stress that a lot of people are feeling, and also the economy wouldn't be under threat as it is right now. And so even if you don't take the perspective of how this crisis is affecting the average, middle class American or median family who isn't able to pay their rent or their bills or their mortgage, if you just look at it from the broader macroeconomic picture, or the health of the economy in general, it's still a big problem. Because usually, if one person gets evicted, it's not the biggest deal for the bigger economy, because the bank is able to foreclose on them, and then they get back the house, and so they really don't lose that much. But when that happens to too many people, then there's a systemic failure, and then the housing market crashes, and then the assets which the banks pick up from the people not being able to pay their loans aren't worth as much, and that leads to a banking sector collapse, as we saw in 2008. And because mortgages are tied up into conglomerated assets, which are sold off to mutual funds and to other people's as mortgage-backed securities, when the mortgages go down, so do the mortgage-backed securities, and so do the pension funds which bought those mortgage-backed securities. When the pension funds goes down, then the middle-class people who have just been foreclosed upon now don't have a retirement savings, and so they're not able to pay, they're not able to purchase as much goods, and when they're not able to purchase as many goods, then the economy fails further, and more people are laid off because there isn't investing, because people think that the amount of goods bought tomorrow is going to be less than there are today, and so we need to scale back production, which means that more people are unemployed, and those unemployed people then stop buying goods themselves, which leads to a further recession, which is kind of what we saw in 2008, which is one of the reasons why the government had to, or at least said they had to, come in and bail out all of those banks, which crashed the economy because they were too big to fail. And in a certain sense, that was true. And that happened in 2008. We're about to have it happen on a scale that we haven't seen before, because 32% of mortgages and rents not being paid is unprecedented. And like I said, the household wealth still isn't there. Jobs aren't going to be coming back anytime in the immediate future, at the very least. And so when eventually the evictions start, there could be a homelessness crisis that we haven't seen for a long time. And even if there were still moratoriums on evictions, that wouldn't change the fact that because the money isn't flowing from the people renting the houses or doing the mortgages back to the landlords or the banks, and let me emphasize, even for rental agreements, the money goes back to the banks because the landlords a lot of times end up taking out loans in order to build the apartment units or the housing, which they have to pay back, and they expect to pay it back through the rental agreements. And so when that money isn't flowing, then that means that the banks aren't getting the loans, which means that eventually those loans are going to go bad, and the conglomeration of mortgage-backed securities or whatever else it is that they stuff those loans in to make financial instruments are going to go bad as well. And that's the foundation for the house of cards, that if a few cards come out of, the whole economy crumbles. And so we'll see what happens, but it's a really bad situation. And it's not just because of the coronavirus. The coronavirus was the little flick that knocked the boulder off the ledge. But the reason that it had been pushed there in the first place was because of the income inequality and the fact that wealth has been flowing to the richest people at the expense of middle class people who've had their assets depleted for years, and now the chickens are coming home to roost, and it's going to be pretty scary. But more people should be talking about it, because this is an economic indicator the likes of which I haven't ever seen, and is a lot more important than things like old statues being pushed over in a couple of cities around the country, which is what the president wants to focus on. But we'll see where we're at in 6 months.